Hey guys, Bob Hertzog, your real estate dad. I brought in my good friend Lizy today to talk about where rates are today and where they might be headed in 2026. You know, there's a lot of opinions floating around out there in the news, and whenever things get crazy, I always like to bring Lizy in to kind of explain everything to us. So I think you'll find this to be very informative. And thanks again to Lizy for coming in. Talk soon. Hey guys, it's Bob Hertzog, your real estate dad. I'm here with my favorite lender again, Lizy Hoeffer, and wanted to talk about a couple of things today. Mainly, I wanted to have Lizy just talk to us about kind of where rates are right now, what the heck is the Fed doing or not going to do, and kind of wrap it up with, I wanted to talk a little bit about all of a sudden we're talking about arms again. 7-1 arms and 5-1 arms and 10-1 arms, and people are losing their you-know-what over that, some people. So anyway, Lizy, what is going on? I mean, 2-3 weeks ago, you'd watch the news and they'd say, oh, we have a 30% chance that the Fed's going to cut rates in December. We have a meeting coming up with the Fed's December, is it 20th?
The 10th.
The 10th. Okay. Oh, that's sooner than I thought. So in the last 2 weeks, that's gone from 30% chance of cutting a quarter point now to like 95% chance, depending on what you read or who you're listening to. So first of all, what are you hearing the same thing? And why all of a sudden are we talking about rate cuts again when 2 weeks ago we weren't?
Yeah, so it's a really nuanced topic that depends on a lot of data. And with the government shutdown, um, there just wasn't any news, quite sadly. And we have a very, very conservative Fed
Yep.
right now. The majority of the chairmen believe that the economy is strong and that there's no need to drop the Fed funds rate. And there's a couple of reasons for that. One thing I want to make sure that people that are watching this understand is that the Fed funds rate, it does not impact mortgage rates,
Yep.
right? So this is the rate on your credit card. This is the rate for auto loans, short-term loans, like the interest on a HELOC.
Mm-hmm. Mm-hmm.
This will also impact ARMs, so adjustable rate mortgages,
Okay.
because that's what is adjusted based on prime. So it impacts a lot of financing, but not directly mortgage rates. Now, the talk of lowering the interest rate, the Fed funds rate, impacts mortgage rates. And that's because it's a very diverse financial system. So anything that is like when they talk about dropping the Fed funds rate, it's typically because the economy is not doing great.
Right.
Okay. And when the economy's not doing great, people assume that Wall Street's not going to do great. So they withdraw the money and they look to avenues like the 10-year treasury note for security. And then you can only draw on that so much before the yields get really watered out. Right. So you have less returns on a 10-year. And then people go to mortgage backed securities. Right. And so that's why we'll see interest rates drop. But what I think most people don't understand is that because there's so much data coming out, I mean, you have so much commentary. It's like, betting on a sports game, right? Like you might have an injury for a star player, and then all of a sudden your odds on how that team's going to perform completely change. Or you might get bad weather, same jam, right? Or something happens to the coach, or there's a scandal, or so many different things can happen that will impact somebody's ability to win or not win a game. It's like that with the economy. And so you had a bunch of commentary from the Fed chairs, and they were like, nope, the economy's strong, employment's good. We don't foresee an interest rate reduction. And so then you have all the odds saying, well, they just said no. So the probability is no. But then you get unemployment report, and what came out today was the ADP. So they handle the majority of payroll for the private sector, and they're showing that there's like a $38,000 job loss for
38,000, not dollar,
the
38,000.
jobs lost last month.
And that's
And that is horrible for the employment mark. So mortgage interest rates are going to follow the unemployment number. So if we see that there is data that says employment is weak, it signals that consumers won't be able to buy things. More layoffs are coming, and people just assume like economic distress. Like, if people lose jobs, I mean, they stop spending money, there's more job losses, it's a bigger problem, and that's when the government comes in, and they're like, "Okay, we've gotta stimulate things."
Okay.
And that's what happened today. So now it's gone from, "They're absolutely not gonna do it," to, "Hey, it looks like they're gonna have to do it because the employment market does not look good."
What were they expecting? Did you hear, like, what the and how far off was it? Because I know we haven't had any jobs reports because of the shutdown for, like, 2 months now, right?
Yeah,
I mean,
we have.
and this one really isn't a jobs report, it's just kind of a ancillary report, but it does tell you kinda where things are going.
So what's hard about the BLS report is that the BLS report is constantly revised. And so and the reason is because they have like the death rate model, and they try to show like, they make a lot of adjustments for things like that. What I will say is I don't know what the numbers were, but generally speaking, they want to see that there's like 50,000 to over 100,000 new jobs that are created every month. And so when you have negative job growth, what that says to me is that, okay, if every month there's a X number of layoffs and you expect that within the X number of layoffs, and job openings just in general, you expect to see that made up in job openings.
Okay.
Okay. And if you are seeing layoffs plus negative job openings, it just means that the unemployment number is going to rise, and that in and of itself is just like a precursor to things like a recession,
Right.
you know.
And that's bad for the economy, but good for interest rates.
It's a yes, look, guys, whenever you're buying a home or you're wanting to refi, you want something bad to happen to the economy.
It's off.
I mean, it is awful. It is awful. You want a hurricane to happen, you want natural disaster, you want a war, you want all kinds of things that will disrupt
Right.
the economy. That's what it does. When people are talking about, how great COVID was, they forget how awful COVID was. Like, so many small businesses closed down.
Yep.
So many people died. I mean, let's get real. I mean, it was a horrific time,
Right.
and yet the silver lining was a 2.5% interest rate.
Yeah. Yeah. So what do you think's gonna happen? I mean, obviously, they're gonna do the quarter point drop, the Fed, on December 10th. Have mortgage companies already built this in, or after do you think tomorrow we'll start to see some effects from the news that came out today?
So mortgage companies don't price it in. Like, 100% interest rates are driven by the mortgage-backed security market.
Got it.
So it's just like a security, just like stocks, just like the 10-year treasury note. The value and what they're worth is based on investor concentration. So as far as mortgage interest rates, right now, there's this thing called the spread of risk between a 10-year treasury note and a 30-year fixed mortgage-backed security. And normally those types of investments, they trade in parallel. The 10-year treasury note's like a for sure get my IOU from the government. A mortgage-backed security has some risk. So you have early payoffs, you have people who refinance, you know, there's foreclosures. I mean, it's not a guaranteed payback, but it's a pretty secure long-term rate of return, okay? So mortgage-backed securities always have to pay higher than a 10-year treasury note because of risk. And so the difference between the value of a 10-year treasury note and mortgage-backed securities is known as the spread. So the riskier the market, the higher the spread. So in the last couple of years, they thought the economy was going to rebound much quicker, and there was this very highly anticipated belief that there was going to be a massive wave of refinances. And so if you believe that your investment in a mortgage-backed security was very short term, which is why we had that inverted yield curve, right? So long-term or short-term rates looked better than long-term rates because it didn't look like the long-term rates were really going to pay out.
Right.
That's why interest rates rose to 8%, because that's how high the return had to be to attract investors for short term. And so that's how it works. So we're in a much more normalized spread because interest rates have been higher for longer. The massive, like, okay, interest rates are going to drop into the fours isn't really there. So they don't anticipate as high of an impact for refinances. And so when you look at that, like, if we had a normal spread between the 10-year and the 30-year back mortgage. And I know this is like super nerdy,
No, no.
but interest rates would actually be today around 5.875.
Okay.
Okay, if we had a normal spread.
Yeah.
Okay, I think that's going to way balance out next year.
Okay.
Okay, because as rates become lower, I mean that trajectory for long-term returns is higher.
Right.
Right, and not as many people are gonna refinance a 5.25 rate or a 6% rate the same way that they are absolutely refinancing an 8 or 7% rate.
Yeah. Yeah.
So, when you look at that, I think that no matter what, the spread's gonna even out. I think rates will get into the 5s somewhere in the first quarter. This is my opinion, okay? I'm not clairvoyant.
Yeah.
So, I think they're gonna be in the 5s. Typically, we see that happen. The rates are typically the lowest historically in January
Okay.
because that's when we see the highest rate of unemployment. You lose all the seasonal jobs, people are making big cuts depending on what happened with holiday sales, etcetera.
Right.
Okay. So that's typically when interest rates are the lowest. So I anticipate it being somewhere there. And then I think that, based on history and how we've reacted to almost every single other economic crisis, typically we were reacting, not being proactive. And this employment situation might already be out of our control. And there's a lot of reasons for that. They've kept the cost of business way up with the Fed funds rate because this impacts businesses mostly because of their lines of credit and, just borrowing from banks. And when it's more expensive for banks, the rates that they provide are more expensive. It's just, credit.
Mm-hmm.
So they've made it really expensive. And then now we have AI that's replacing a bunch of jobs. So
Right.
this idea that, the employment market is so solid is not there, and normally we've seen it take, like, 2 years to fix something like this. So we might be chasing having to stimulate the economy for some time. Now, I don't know if we'll ever see rates in the 3s, okay? I don't know if we'll ever see it. It's very, very dependent on what they need. One thing I can tell you for sure is that we are undersupplied in homes. Like, people get very confused because right now it's a buyer's market and there seems to be more supply, but that's because demand is suppressed.
Yes.
And
Correct.
so for the moment, there is less demand for the supply available at 6.5% rates.
Yeah.
If there's 6% rates, now you've tripled the amount of competition to enter the market for the same pool of homes that are available. It completely changes demand and supply.
Right.
And so we know that based on the number of houses that are constructed and the number of new families created, because that's numbers.
Mm-hmm. Mm-hmm.
I think did you see that crazy Redfin report?
No, I don't think so.
They're the one that said that there were 500,000 more sellers than buyers.
I didn't hear that.
It
That's
was
nationwide.
yes.
Yeah.
It's like literally okay. I don't know if I can say this, but never get your economic news from Redfin.
No.
Whoever they've hired as the forecaster is literally
You know who I've been listening to lately is your buddy, Logan
Motashami? Yeah,
Modishami.
he's fantastic, and he's a
Everett's.
real housing analyst
That's
who studies things like there's no way to track buyer demand. 0.
right.
Like, there's no way to track it.
It's a feel, right? It's a
But to
gut
say that
feeling.
there's
Yeah.
500,000 and then the numbers that they were using were based on housing permits. So, okay, sure, there's a cajillion housing permits, but how many of it takes, like, a year to build a house?
Yeah.
And they do it in phases?
He's really big on construction related jobs too. He really watches that.
Well, because it's a recession marker.
Right.
So, normally what happens is manufacturing jobs go down, construction jobs go down, and then you're in a recession.
Right.
And so we have low manufacturing jobs. Construction jobs for real estate have maintained, but if they were to go, that would be a thing. And part of the reason that the Fed has really made sure that mortgage interest rates stay high is because of this undersupply.
Yeah.
Like, if anything shifts in affordability, it's like, I mean, it raises the value of homes so quickly.
Yeah.
And I don't think people have very short-term memories. They think that whatever is happening today is what it will happen always. And it's like, 2021 wasn't that long ago, and yes, the interest rates are probably too low, and it made too many people available to purchase,
Yeah.
but that supply and demand issue, it didn't get better, it actually got worse because more kids were born. More families were created since then,
Interesting.
and not as many homes were. So that And I know we'll get into this later, but that big debate about the 50-year mortgage, lots of people were concentrating on interest, but if you looked at the housing analysts, they were like, "This is going to be catastrophic for home prices. If you want to improve home affordability, you have to put more supply into the market."
Right. That makes sense. Okay, good. Well, let's wrap up. I mean, I just wanted to get a feel for kind of where the market is and where it's headed. I mean, generally speaking, though, it's a pretty positive outlook for interest rates. Unfortunately, not a real positive outlook for our economy if we're losing a bunch of jobs and if inflation starts to go up and that sort of things.
Inflation will come down if people lose their jobs,
Yeah.
so there's that too. So, like,
Yeah, exactly. Now, the other thing that, before we wrap it up real quick, they're really talking about the next Fed chairman being this Kevin Hassett that, I mean, and there's a lot of people, including Logan, that feels like he's more dovish is what he calls it, and will probably be more aggressive with Fed rate cuts. Is that kind of your feel too and what you're hearing?
whoever Trump selects is going to pass on his agenda, and he wants somebody that is going to drop that Fed funds rate.
Yeah. And even though it doesn't have a direct effect, it does have a correlation to it somewhat.
However people feel about the economy is it depends, right? So it's like, it all depends on if they believe that what is happening is going to benefit the stock market or not. So what ends up happening is when they actually make this change to drop the interest rate, okay, what happens is it has a benefit to the stock market. And typically on the days when they drop the Fed funds rate, mortgage interest rates go up. And it always is shocking to everyone. And I'm
Yeah,
like, you
I've
guys,
noticed that.
why is everybody shocked? This is like how it always is. Because today, everyone's been anticipating these awful news results, and the stock market's already taken a hit. Okay, they've already taken a hit. We've already seen the gain in mortgage backed securities. This has now made things more affordable for business, okay, which is going to improve those conditions. People are going to take some of their money out and replace it back in the stock market.
Yeah.
And that's what always happens. And like, if you understand that game,
Mm.
then it's good. So if people believe that these Fed rate cuts are going to really dramatically improve the Wall Street, it won't be as good for interest rate.
Yeah.
It just really depends. If they feel like, oh my God, we're headed into a recession, we can't improve this employment situation. Every single time they announce a Fed reduction, it'll improve rates.
Right. Right. Okay. Great. Well, thanks for coming in and talking to us about it. There's so much crap out there on the airwaves of everyone's got a different opinion on things. And a lot of times we just need to hear it from somebody that's boots on the ground that's seeing it every day. So I appreciate you coming in and sharing this with us today. It's great info for everyone.
Totally. And if I can say one last thing,
Yeah.
I think whether it's lower interest rates or different mortgage terms, or they're talking a lot about adjusting the loan level price adjustments, buying a home in 26 is going to be a lot more affordable, and it will be a much different market than the last 2 years.
Right on. You heard it from the pro, Lizzie. Things are going to get better in 26. So, all right. Thanks again.